Okay, good evening and welcome back to our beginner's options course. This is part two of our beginner masters options course series to help you better understand how to utilize options for your portfolio. Today's session is building on top of what we just covered a couple of weeks ago, which was just a very brief introduction to options. We talked about the benefit of options and what you can achieve utilizing options as an asset class for your portfolio. And then we dived into the basics of what a call and put option really means. So today what we're going to do is we're going to build on top of that and look at buying versus selling options. We're going to look at both calls and puts. We're going to go through a few different examples and then show you in the real world how you should go about analyzing whether you want to buy a call, sell a call, buy a put, or perhaps sell a put. Now, a lot of the themes that we're going to go over here today will be somewhat theoretical. In future webinars, we will cover how to actually apply these strategies to your actual portfolio. But right now, what we're focusing on are the fundamentals of options so that you understand what it means to construct these four strategies, because all other strategies that you learn in addition to this will be built on these types of strategies and understanding. So let's go ahead and get started here. First, before I do, just a quick disclaimer. What we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or a recommendation to buy or sell any specific securities. And for those of you that are brand new to options play, welcome. First of all, I hope that you guys are able to utilize the tools that we provide you with. It is completely free of charge. This is partnership that we have entered with NASDAQ to help bring you education, tools, and different resources to help you learn and implement these option strategies in your portfolio. And this is all available to you free of charge simply by going to optionsplay.se. You're going to get access to the full platform with real-time quotes to analyze Nordic symbols and options on those specific symbols, access to bi-weekly educational events like this one that you're on here today, and access to a full video library so that you can look back and review any of the educational events that we have hosted in the past to help you learn and better understand how to utilize options in your portfolio. And lastly, we publish weekly cover call and short put reports for those of you that have some experience trading, some of the basic strategies that you'll implement in your portfolio. We scan the entire Nordic market for all optionable symbols and show you where you have opportunities to generate income utilizing options. That's one of the topics that we covered last week as to one of the main use cases for utilizing options, which is generating income. So like I said, today is going to be part two of a multi-video series. Last week we covered, or a couple of weeks ago, we covered the basics of what a call and put option, what the option contracts mean. And today we're going to get into buying and selling calls and puts. Now, before we do that, what we need to do is first have an understanding of the difference between trading stocks versus trading options, because when we talk about trading stocks, that is what I consider a pure bullish or bearish view on an underlying stock. Now, when we talk about option strategies, they do fall into two categories: bullish strategies and bearish strategies. But within each category, they're not, in my opinion, straight bullish or bearish strategies. And between buying a call and selling a put for a bullish strategy, they're actually quite different from each other. So it's really important that we explore the differences between the two so that you understand when you should deploy one or the other. And same thing for bearish, same thing, buying a put versus selling a call are quite different from each other, even though they are both considered bearish strategies. So we want to make sure that we cover that for you. And then what we want to do is we want to go through some examples if possible, using options play to show you some real symbols and looking at buying a call, selling a put, buying a put, or selling a call. And I hope that after this event today, you'll be able to join us for our March 18th live trading event, where we're going to do some live trading. We're going to look at the markets together, and we're going to be able to look at how to analyze the markets together. So I hope you join us for that, and you're going to be able to join us and ask us some questions. So those are all coming up over the next few weeks, and I hope that you guys really are able to join us for that event. So let's go ahead and get started here. let's first talk about stock trading, because this is a strategy that most of you are probably familiar with. So the thing about trading stocks is that this is what I consider purely a bullish or bearish exposure. Meaning, if you buy a stock because you're bullish, you will make money immediately as the stock starts to move higher. If you short a stock, you will start making money immediately if the stock starts moving lower, and vice versa. You start losing money if the trade starts going against you. So this is what we consider symmetrical exposure, meaning you get dollar for dollar exposure. If it goes up, you make money. If it goes down, you lose money. And you can do this over any time horizon. You can buy a stock and hold on to it for as long as you want. The only limitation you have with trading stocks is that you don't have any neutral options. So if you think a stock is going to trade sideways, meaning you think it's going to go maybe up a little, down a little, and you think it's just going to go sideways, and you don't think it's going to move a lot, then trading that stock, there's not a lot of options for you. And that's really where options come into play, because when you're trading options, you truly have a lot of options. Now, in the previous week, we explored 4 different strategies, very basic strategies, and we discussed what each one of those mean. We talked about buying a call, which gives you the right to buy the stock. We talked about buying a put, which gives you the right to sell the stock at a specific price. And then we talked about the seller of that option, which has the obligation to sell when the call buyer wants to buy, and the put seller has the obligation to buy when the put buyer wants to sell. So the two are on the opposite ends of each other. So we explored how buying a call versus selling a call are opposite ends of each other, and buying a put and selling a put are opposite ends of each other. But today, what we're going to do is we're actually going to explore the strategies in a different format. We're actually going to look at buying a call versus selling a put, because these are both bullish strategies. And then what we're going to do is we're going to look at buying a put and then selling a call, because these are both bearish strategies, and we're going to compare them in a different light. So those are the 4 strategies we're going to explore here today. So we're going to start off by talking about buying calls. So for this particular strategy, I'm going to use a theoretical trade. I have stock XYZ that's currently trading at 100 crowns. And let's say my outlook on this stock is I believe this stock is going to move higher. So I think it'll move up to 105, 110, 115, however higher I want to go. However higher I think the stock will go, but I'm bullish on this particular trade. So one of the options that you can utilize for your bullish outlook is to buy a call option. And a call option has what we consider limited risk, meaning no matter what happens, the most you can lose is a certain amount, but you have unlimited reward for that. And this is something that we covered basically, from a very high level last week. So let's dive into this a little bit. So the example here that I have is, let's say I'm bullish on stock XYZ. So I buy a call option. I buy a 100 crown call option, and let's say I pay $4 for that call option. My max risk here is just 4 crowns, because when I buy a call option, no matter what happens, that's the most I can lose. My max reward here is unlimited, right? So you guys remember this P&L chart that we looked at last week? We actually constructed this ourselves. We actually walked through the steps of how to construct one, which basically showed you that as the stock went higher and higher, the call buyer is able to make more and more money. And if the stock goes in the opposite direction they expect it to, the most they will lose is the 4 crowns that they paid for that call option. And this is a risk to reward ratio that many people are looking for, because who doesn't want to make lots of money if they're right and then lose limited amounts of money if they're wrong? But the downside to this strategy is the fact that when you pay 4 crowns for a call option, not only do you have to be bullish on this stock, you have to believe that the stock is going to move 4 crowns in your favor before you make any money, which means that not only do you have to be bullish, you have to be bullish by more than 4 crowns, 5 crowns, 6 crowns, 7 crowns, 8 crowns, but you have to be bullish by more than that amount in order to be profitable on this trade. And that's why when I say a call option is not just bullish, it's bullish by a certain amount. That's what I mean, is that you have to be bullish by the amount that you're paying for that call option. So the next time you're thinking about a bullish trade and you're thinking about buying a call option, not only do you have to think about how bullish am I, you also have to look at what is the cost of that call option. because that is something that you have to factor into to determine whether or not it makes sense to buy that call option. So this is something that most stock traders aren't considering when they're thinking about, oh, I'm bullish, so I'm going to buy the stock. Here, not only do you have to be bullish, you have to look at how much do the calls cost, and do I think the stock is going to exceed that amount by the expiration date in order for it to make sense for me to buy that call option. So there's a huge distinction here that's important when you're buying a call option. So you have to ask yourself, do I think this stock is going to make a 4% rally between now and the expiration date? And if I do think that's going to happen, do I think it's going to exceed that, right? Because if you think that it's going to move 4% higher, you're actually not making any money on this trade. And this is really, I think, one of the more frustrating parts about learning how to trade options is that if the stock actually goes in your favor, so meaning if the stock goes higher, right? You thought it was going to go higher and it does, but it only moves 3 crowns higher, you actually lose money on this trade. And that's something that's hard to swallow for a lot of traders, is being right on the direction and then losing money on that trade. And this is the, I would say, more difficult part about trading options, is understanding how far does the stock need to move, and then asking yourself, do I think it's going to move that amount or more in order for it to make sense for me to buy that call option. So whenever you're buying any type of options, whether it's a call or a put, you have to factor, the most important part is, how much does the call option cost? That is one of the biggest decisions, biggest factors that you have to look at before you decide to buy a call option, and ask yourself, do I think the stock is going to make that big move? Now, what I'm going to do now is I'm going to flip this on a dime and say I'm still bullish on stock XYZ, but let's look at another strategy. So I'm still bullish on stock XYZ that's trading at 100 crowns. I think it's going to move higher. Whether I think it's going to move 1 crown higher, 5 crowns higher, 10 crowns higher, I'm not sure, but I think it's going to move higher. So we know that selling a put is also a bullish strategy, but what I want to show you here is that technically it's not really a bullish strategy. It's what I call somewhat bullish, but not too much. Now, that might be a little confusing to some people, but think about this for 1 second as I walk you through this particular trade. So when you sell a put option, this is something that we went over again a couple of weeks ago. We know that we walked through the example where a put option, selling a put option, has a risk profile that looks like this. Meaning, if the stock moves higher, I keep the 4 crowns because I sold someone the put for 4 crowns. If the stock is above the strike price that I sold it for, the person who bought it for me is not going to exercise their put, so I'm going to keep the 4 crowns. If the stock moves significantly lower, that is when it makes sense for the put buyer to buy those, to exercise their put. And the further the stock goes lower, the more money I lose as a put seller. So when does it make sense for me to sell a put? The answer is, number 1, I think the stock is going to move higher. Also, if I think the stock is going to move a little bit lower, that's okay. I still can make some profit if the stock moves a little bit lower, but not too much. But as you can see, if the stock moves significantly higher, yes, I still make a 4 crown profit. But notice how, if we look at the previous slide of buying a call option, that's where I'm severely underperforming buying that call option, because if I bought the call option and the stock moves significantly higher, then I make more money on the call option. That's why when you're selling a put option, this is what we call somewhat bullish, but not too much, because if you are really bullish on this, you're better off buying that call option. So it's really important to understand the distinction between saying quite bullish by a certain amount versus saying somewhat bullish but not too much, even though these are both bullish strategies. So it really just depends on your outlook on this particular stock. And not only do you, just like the call option where you have to factor into how much money does the call option cost, you also have to factor how much premium am I collecting when I sell this put, because that also determines, number 1, what is your potential profit on this trade, right? So here you can only make 4 crowns because that's what you're collecting by selling this 4 crown trade. But 4 crowns is also the buffer that you have, meaning if the stock moves more than 4 crowns lower, you start to lose money. You don't want to lose money on this particular trade. So you have to ask yourself, do I think this stock is going to stay above 96 or higher in this particular case? Because my max risk is my break even on this particular trade is 96 crowns. My max gain is if the stock is above 100 crowns, and I'm making a possible 4 crowns while risking 96. Now, a lot of people will say, why would anyone take this type of risk reward ratio? And the answer is really the fact that in reality, you can ask yourself, well, how far do I think the stock will go, between now and expiration? Let's say you think it'll be somewhere between 110 and maybe 90, right? So you can ask yourself, well, what is the true risk reward here? The answer is that the most you can lose here to the downside is roughly six crowns if the stock goes down to 90. And here you make 4 crowns if the stock goes up to 110. But pretty much anything above 96, whoops, let's make this a little, anything above 96, you're going to make money. So most of the time, you're going to make money. You have, I would say, about an 80% chance you'll be profitable on this trade, and maybe a 20% chance that you might lose 6 crowns. So that's why most people will sell a put option. And this is something we'll get into in some future educational events where we talk a little bit more about selling puts and the benefits of this, because there are significant benefits to selling puts. It's the strategy that I highly advocate for users who are trying to buy stocks. But just so you understand, these are the true types of risk to reward ratios that most people are looking at when they're selling a put. Now, next, let's look at the flip side, the mirror image of this. And it's really not difficult to learn this once you understood the first 2 slides. So here, we're just going to turn things on a dime. We're going to say we have stock XYZ trading at 100 crowns. Now, instead of thinking that stock is going to go higher, I think it's going to move lower. So what are we going to do? The first strategy you learn as an options trader is buying a put option, which is bearish. But what I want to clarify for everyone is that it's not truly just a bearish strategy. It's bearish by a certain amount. And that certain amount is dictated by how much money you pay for your put option. So in this particular case, if I buy a 100 crown put and I pay 4 crowns for it, then I have to ask myself, do I think this 100 crown stock is going to move $4 to the downside, 4 crowns to the downside? If I think it's going to move less than that, then it doesn't make sense for me to buy this put option because I'm going to lose money actually. If it's going to move more than, if I think it's going to move more than 4 crowns, then it does make sense for me to buy that put option. But I also have to factor in how much do I think it's going to move to the downside. If I think it's going to move a lot, then absolutely I'm going to pay for that put option. But if I think it's just going to move to, let's say, 5 crowns, then you have to ask yourself, does it make sense to pay 4 crowns just to try to make 1 crown in this particular case? So that's a question that you have to ask yourself. It's not always an easy answer to a question to answer. Many times traders turn to the charts to understand this, but the benefit of this is the fact that no matter what happens, the most you can lose is 4 crowns. You can short the stock, but if you shorted the stock, you truly have unlimited risk. It looks something like this, right? The short stocks trade looks like this. You can lose a lot of money on a short stock. With a put option, you can lose a fairly limited amounts of capital, only 4 crowns. So even if you're wrong, guess what? You have small amounts to lose. You truly have unlimited reward all the way down to 0. So if you think the stock's going to make a big move to the downside, usually you use this for a stock that you think is going to miss their earnings announcement, a stock that you think is going to severely underperform the market because perhaps they have an inferior product, or you feel that the stock is broken through a support level and you think it's going to continue moving lower. Those are the types of stocks that you want to consider buying a put option, stocks that you think are going to make a big move to the downside. And your break even here is just 96 crowns. And we're going to talk about in future educational events as to how you can reduce this amount, right? So you're paying 4 crowns for it, so the stock has to move 4 crowns in order for you to be profitable. Are there any ways to reduce that amount? There actually are, and those are some of the things we want to explore in future educational events. And your max loss here is if the stock stays exactly where it is or moves higher, and the most you lose here is just 4 crowns. So just like the call option, buying a put option, one of the most important things you want to look at is how much money does the put cost? because that determines how far does the stock need to go in order for it to make sense for you to buy this put option, because a put option is not just bearish, it's bearish by a certain amount. And that amount is determined by the cost of that put. And lastly, we come to selling calls. So same example, stock XYZ trading at 100 crowns. I believe the stock is going to move lower. As you may have learned in our previous example, selling a call option is a strategy that you can utilize that's bearish. But what I want to, again, just like the selling the put option strategy, it's not really bearish. It's somewhat bearish, but not too much. Meaning if you think that the stock is really going to make a big move to the downside, you're better off buying a put option. Risk 4 crowns, make maybe 10 or 15 crowns as the stock really moves to the downside. You can make money by selling a call option if it makes a big move to the downside, but you're capped, because if you sell a call option at 100 crowns, and let's say you collect 4 crowns for that call option, the most you can make is 4 crowns, even if the stock goes to 0. And I certainly would not want to take on the type of risk of truly unlimited downside, because this is the only option strategy that has what we call unlimited risk. Just like shorting a stock, selling a call option naked is like shorting a stock. The only difference is you have a small buffer here, in this particular case 4 crowns. So because if you shorted the stock at 100 crowns and the stock went higher, you lose immediately. Here you get a $4 buffer before you start losing money. That's the only difference here. So it's really important to understand that when you're selling a call option naked, this is not a strategy that we generally recommend. However, we will show you when it does make sense to sell calls, because there is a way to sell calls where you don't have unlimited risk. But here we're just talking about the fundamental building blocks, because buying calls, buying puts, selling puts are the strategies that make up all option strategies. So it's just important that you understand each one first before we dive into how you practically apply these to your portfolio. Lastly, your max reward here is just 4 crowns, like we said, and your break-even price here is at 104. So you get a little bit of that buffer, right? So you think the stock's going to move lower, but even if it moves a little bit higher, if it moves up to 101, 102, 103, or even up to 104, you don't lose money because you've collected $4 up front. That's the buffer that you get. So it's a fairly what we would consider forgiving strategy, and you make your max gain here if the stock stays at 100 crowns or lower. But it doesn't matter if it moves 1 crown lower or 100 crowns lower, you are capped at your 4 crowns. And your max gain here is, we just discussed this, your max gain here is when the stock is at 100 crowns or lower at expiration. So those are the 4 fundamental building blocks of all option strategies. So for those of you that are experienced, you'll learn, selling puts is a strategy that's very commonly used to enter a stock position. Selling calls is a very common strategy used in cover calls to help you generate yield and income on stocks that you own. And these are the fundamental building blocks of trading vertical spreads, buying and selling calls, buying and selling puts, using combinations of each other to create all types of different payoffs that you may want from an underlying stock. But in order to utilize and understand those strategies, you must first understand these 4 strategies. So if this is new to you and this is something that you find difficult, make sure that you watch the recording with the slides and follow along, because it's important that you understand this before you move on to the next strategy. So what I want to do is I just want to go through one real example just to give you a sense for real life example. So here is an underlying stock, and this, I pulled the pricing on this on February 21st. The stock was trading around 34.5 crowns. And what I wanted to show you here is that, as you can see here, this expires on February 28th, which is 7 days from expiration. The March 6th is 14 days from expiration. And then the March 13th is 21 days from expiration. So just to give you a sense for what call options trade like, and this is really giving you a sense for, again, we discuss these things from a theoretical perspective. Let's look at some real examples here. And the question is, are you paying for something that's cheap or expensive? and this is something that you need to start thinking about when you're trading options. So when the stock was trading at 34.5 crowns, a 7-day call option, so an option that expires in 7 days, was trading at around 57 0.57 crowns. So think about that for 1 second. So that means that the stock needs to move 0.57 crowns in just 7 days in order for this to be profitable. So the stock needs to move up to around 35.07 here in just 7 days in order for this strategy to be profitable. And you can ask yourself, do I think the stock's going to move up to 35.07 in 7 days? If I do think so, or if I think it'll exceed that level in 7 days, then it might make sense for me to buy that call option. But notice how when I go out to 21 days, which is giving me 3 times as much time, it only costs 0.79 crowns, which means that I have basically 3 times the amount of time for the stock to move up to roughly, in this particular case, it would be 35.29. So the question becomes, well, if you're buying an option, right, and you're thinking about, I think this stock's going to go higher, what do you think you have a higher probability of happening? The stock moving up to 35.07 or higher in 1 week, or the stock moving up to 35.29 in 3 weeks? I would argue that you generally have way more, if you're bullish on a particular stock, you probably have a higher probability of this happening versus this, because this only gives you 7 days, this gives you 21 days just to move an extra 0.2 crowns, right? So when you think about your options, not only do you have to think about your strike price, the call option that you're paying and how much it costs, but also how much time do you have? So these are some of the things we're going to explore in future educational events as we apply these to real trading events to show you, thinking about this in the context of how much time do I have? How much does it cost? How much does the stock need to move? And then we'll talk about, are the call options cheap? Are they expensive? Because this is something that we haven't really talked about yet, but at this point, you don't know which stock this is. And the point of this is to not think about which particular stock, because you have to put this in the context of each individual stock, because a 0.57 crown move for certain stocks may be very little, for other crowns may be very much. So you have to think about, how do you think about whether a call is cheap or expensive? And that's where we're going to look at terms like implied volatility. These are the terms that you're going to start learning in the next few weeks to better understand how you want to capture this. So with that, what I want to do is I want to jump over to options play, and I want to show you some examples. Here is let's look at H&M, because this is a stock that almost everyone here is probably familiar with. And I think this is a good example to utilize for whether you have a bullish or bearish view. So here's H&M. It's trading at around 172 crowns. The current technical score here is relatively weak, telling me this is a stock that's underperforming the overall market. 1 month and 6 month trends are bearish. It's been bearish for quite a few days here on February 24th. Many stocks turned lower here on this particular day, and it's still below that 183, 184 support level that it formed before that recent move to the upside. I believe that was actually on earnings. So if we zoom out on a chart here, maybe you believe that H&M here is headed significantly lower. I don't know whether you think it's going to move a lot lower or a little bit lower, but let's take a look at a few different options here. What I'm going to do is I'm going to use options play. I'm going to select I'm bearish, and we can look at shorting the stock. We can buy a put, and then what I'm going to do is I'm going to change this to selling a call. And I want to show you what these look like. So I can short the stock, I can buy a put option, I can short a call. So buying this put option cost me 1,100 crowns. So if we look at the break-even price on this, 175 minus 11 crowns is 164. So that's about right here. So you have to ask yourself, do I think H&M is going to be below 164 by the April 17th expiration, which is roughly around right here? So do I think this stock is going to be below 164, or above 164 at expiration. If I think it's going to be below, then I can buy this put option. If I think it's going to be above, then maybe I'm better off selling that call option. So let's take a look at these two examples. Let's see. So selling a call option, I'm collecting 704 crowns, which makes my break even here 182.40, which is up here roughly 182.40. So just maybe let's illustrate it this way. 182.40 is right here. Whoops. 182.40 is right here. Before we said this is 164, which is around right here. I don't know why this isn't drawing today. So let's break this down. As a put buyer, I need the stock to move below this 164 level. So I'm bearish on the stock. It needs to move below 164. As a call seller, I just need the stock to be below 182. So just notice the distinct difference. As a put buyer, I need the stock to go below this bottom line. And as a call seller, I just need the stock to stay somewhere in this range. It doesn't matter whether it goes down here. I make money in all of these possible scenarios. The only time I lose money is if the stock takes off. Okay, so I just want to make sure everyone understands that from a visual perspective when we're thinking about buying a call versus selling a put option. So you can ask yourself and go through your analysis, whether you use technical, fundamental analysis. You can ask yourself, where do I think H&M stock is going to go? And that helps you determine whether you want to buy a put or sell a call. And you can use our P&L simulator here to actually simulate what happens if H&M stock declines. Let's say it declines to 160. Here, as you can see, if it declines to 160, I'm looking at a $400 profit on the put option. Here on the call option, I make a 740 crown profit. Now, when I sell a naked call, I have unlimited risk. When I buy a put, my risk is limited to just 1,100 crowns per contract. So that is a significant difference to also consider. Again, this is more from a theoretical perspective so that you understand these two strategies side by side and see how they perform. Because as you can see, as the stock moves significantly lower, here I'm still only making 740 crowns versus here I'm making 2,800 crowns. So if I think it's going to make a big move, better off buying that put option. If I think the stock is going to stay where it is, then I'm much better off selling an option. And that's the fundamental difference that I think I want everyone to walk away with here today, is an understanding of the fundamental difference between buying an option, which requires the stock to make a big move, versus selling an option, which is generally useful when you think the stock's not going to move too far. But depending on whether you think it's going to move a little bit higher or a little bit lower, that determines whether you sell a put or if you sell that call option. And you can utilize options play at any time to set up any three strategies side by side and use the P&L simulator and see how do these strategies perform. And as you can see, what really happens is that if the stock moves significantly higher, selling this call, you're at a huge loss versus buying the put. You have limited loss. On the opposite end of the spectrum, if the stock really goes in the other direction, here you have limited profit, and here you have unlimited profit. And it's really important to use the slider and just see the full spectrum of where you think the stock's going to go and how these strategies perform to get a better understanding of whether you want to buy or sell an option, because all future option strategies that you're going to deploy in your account will require you to make this fundamental decision as to whether you're better off buying or selling options. And with that, I want to thank everyone for taking the time out here this evening to take the time out and really learn more about options trading. I hope that this was useful for you guys so that you can better understand how to utilize options in your portfolio. Like I said, this is just part 2 of a much longer options education journey that we are embarking on with you in 2020. This is the first beginner's master course that we are putting together. Part 1 we just did a couple of weeks ago. Part 2 we covered today. Next week, in a couple of weeks, what we're going to do is we're going to actually take what we've learned in part 1 and part 2 and actually show you some real examples, just like this H&M one, but we're going to spend the whole time just looking at examples that you want to look at, as well as answer all of your questions after you've had some time to review part 1 and part 2, the recordings, and then come to the sessions next week, and we're just going to go through live market analysis and answer your questions. And then once we finish with that, we're going to start all over with the next section of options education, where we're going to start getting into a more practical approach to utilizing these strategies in your portfolio. We'll start off with basic strategies like cover calls and cash secured puts, basic strategies to generate income for the equity positions in your portfolio, and then again, repeat that cycle where we go through live market analysis and answer your questions before we continue on with more and more education. So I'm really looking forward to having you guys on board here in 2020. I think we're off to a really great start, and I look forward to showing you guys how to utilize options in your portfolio. I hope you guys have a great evening, and I will see you guys in a couple of weeks.